Hi, everyone, and welcome back to another episode of the Midtown View. I'm your host, Jim Wenk of Savills, and it is Wednesday, April 1st, the beginning of second quarter 2026, and we have another very important episode today. Joining me is Matthew Schreck, head of Tri-State Research for Savills. And Matt, welcome back. Thank you again.
Thanks for having me, Jim. It's great to be back on the show and happy to and excited to talk about our latest findings in the market from Q1 and where we think things go from here.
Yeah, it's Q1. I know today's April Fool's Day. It was no joke. I mean, the market is continuing at a robust, extremely robust leasing pace. And I know you have all the numbers,
Yes.
statistics that we'll go through, and we have some overarching themes. A lot of continuation from last year.
I think so.
But really looking forward to your thoughts and feedback as always. So thank you.
Yeah, it's a great day to be talking about this stuff. Our new Q1 2026 Manhattan market report just came out this morning, so it's more timely than ever. Really interesting, a lot to dig into. I don't want to go too crazy and get too far into the weeds, but just some headline numbers as an appetizer. 12.4 million square feet of office leasing volume in Manhattan in Q1. So that was up slightly from both a quarter ago and a year ago. If you remember back to Q1 of 2025, which seems like a long time ago now, that was sort of in anomalous, like strong, robust leasing quarter, because I think we've talked about before, Q1s can sometimes be a little soft in cyclical fashion because you have a lot of deals that close at the end of the calendar year, and then there can be a little bit of a lull going into the new year. So now 2 straight years where that has not at all been the case. It seemed to me like it might be the case when I was sitting here at the end of February. And through January and February, we only had tracked about 5.8 to 6 million square feet, but there was really a huge surge of activity in March, headlined by, of course, Bank of America's 2.2 million square foot net lease of One Bryant Park, which is really the standout deal of the quarter. So strong leasing. We saw the availability rate for overall Manhattan decline another 60 basis points from 15.5% last quarter to 14.9% this quarter.
So we broke the magical 15% barrier. Yeah.
Midtown overall is down to 13%. So really continuing to decline across the board. And I think Midtown South is worthy of a special shout out this quarter because we saw about 3.2 million square feet of leasing volume in the Midtown South market, which we broadly define as about north of Canal Street to like 32nd Street.
Yeah.
So that market saw 3.2 million square feet of leasing, which was its second strongest quarter on record ever that we've tracked, driven of course by all the AI firms that are taking more space. So that part of the market continues to heat up. And rents are growing. Rents are up in mid 4 to 5% range year over year. Trophy rents are really growing in outsized fashion as available space in the best buildings continues to dwindle, and then of course owners respond in kind with more rent increases for those kind of spaces and buildings. So that's a summary of what we're seeing, and excited to kind of dive into some of those topics more.
By the way, for any of our viewers or subscribers, if you don't get a copy of our quarterly market reports, please DM us, subscribe, and we will make sure you're on our distribution list. So interesting. I think last year, if I remember, total leasing by AI companies, to go a little further, was like 1 million square feet or so.
Yeah, 1 million and change, just about.
And I think we were just talking before we got on that it's already surpassed that.
Yeah, I can't say I was expecting it to surpass last year's total quite so fast, but about 1 million square feet of office space leased by AI companies in Manhattan in the first quarter alone,
And
which is crazy.
It is, and I know our team is closing on one, this week that will be reported in the second quarter second quarter report for 65,000 feet. And what's interesting, my observation about the AI companies is I'll call it the graduation from, serviced office to a short-term lease to then a long-term lease. That timeline is probably the most compressed I've ever seen since I've been doing this, been in the business. And that just shows the rate of hiring and the rate and the speed of execution. So when they need to accommodate hiring and talent retention and recruitment, they are just looking really diligently, really quickly, and making quick decisions and executing. So whether that's building out a long-term lease or taking a shorter lease, they are making very quick decisions. And I think just like any other new burgeoning industry, there'll be winners and losers. Yeah. We'll look back in 3 years from now. The AI sector is here to stay clearly and will continue to grow, but inevitably there's always some consolidation, and not every single company will be around, but there'll just be a lot of evolution around it. So yeah. I think it's we talk about different sectors that diversify our economy, and whether it's healthcare, whether it's education, nonprofits, finance, legal. Now we have this really rapid growing sector of tech. So super, super exciting.
It's really exciting. And I mean, I feel like we see so much evolution in such a short amount of time in terms of the different applications and the different types of AI-centric firms that are targeting different niches of economic and business activity, and that's where a lot of the growth is coming from, is there's all these different avenues to explore, and that's why you see, I think part of the reason why you see so much growth of these AI-centric firms that are having, finding success and growing their headcount quickly, and then they have a need for more space.
Let's, not to switch gears, but staying on a similar topic of, how competitive it is getting to secure space. I think on previous episodes we talked about how competitive it is on Park Avenue. We all know that. Very low vacancy, especially amongst the trophy buildings and a lot of the higher floors. But now we've seen that permeate to, call it the tech type spaces, evidenced by the tremendous leasing in Midtown South. But we're kind of seeing these companies, different companies bleed, right? Whether it's they want to be in Midtown South, but they didn't secure exactly what they wanted, so maybe they're going to Lower Manhattan, maybe they're going slightly into Midtown. But from the teams and brokers and other research analysts you speak with, are you kind of seeing and hearing the same thing and kind of, yeah.
100%, yeah. I think most of the activity continues to be concentrated in Midtown South, especially the east side of Midtown South. Union Square, Flatiron, the area around, Madison Square Park, even Soho to an extent. There's more cropping up there. Less so on the west side of Midtown South, but you're right. As those types of perhaps most sought after areas and spaces fill up and become more competitive, we're seeing activity radiate out to Lower Manhattan, like you said, and to specific parts of Midtown. The area around Grand Central comes to mind, especially just south of Grand Central. So we're seeing that spread for sure. I think Lower Manhattan is a very interesting one in particular, just because it's been the slowest area to recover, broadly speaking. So there's still a great deal of opportunity there for firms who that location works for. So we're definitely seeing more of that. I feel like the spread overall, if you look back at, let's say, the last 3 years, is roughly 60% Midtown South, maybe 35% Midtown, and 15% downtown. But I think the downtown share is growing.
Yes. Well, let's maybe continue on that, because my observation is the buildings at the World Trade Center are very well leased. They're pushing pricing. The availability rate is plummeting quickly. You have a lot of companies that are expanding, even existing tenants that are expanding within the World Trade Center. You have, or they're attracting new companies like at One World Trade. But then, Brookfield Place is pretty well leased. They have a couple pockets. I think one of the biggest pocket of availabilities will be the former Moody's block at 7 World Trade that comes available next year. They're moving over to Brookfield Place. So that will leave a large contiguous block at 7 World Trade. And from what I understand, they have pushed pricing close to $120 a foot, which is quite amazing for new, I'll say it's newer construction.
It's already kind of a far cry from where we were, a year and a half ago. I think they've pushed pricing in a lot of those areas and those specific buildings quite a bit. But it's indicative of how the market is performing and how much demand there is for space. I mean, you talk about the impending Moody's block for when they eventually relocate, and I feel like everyone who is working on a large requirement or pursuing a large requirement or thinking about large blocks of contiguous space in Manhattan and where they're located, where they're currently available, where they may become available, that was immediately on everyone's radar. And there are people circling and firms circling that on their lists already.
And then you also have, I guess, the top block at One Liberty that's still available.
It's still available, yeah. And buildings like that are interesting because there hasn't been a lot of activity, on buildings like One Liberty and some of the Water Street buildings to this point. But you figure eventually they have to be, more considered as the market for large blocks of space continues to tighten. Of course, you have to have the right user, who that works for, but certainly good, high quality buildings.
So what do you think happens? So we talked about the World Trade Center, all the activity there. What do you think happens Broadway and East? So Lower Manhattan, Broadway to East, right? You have 60 Wall Street, which has been out there. And there's discussions of maybe partially be turned into residential, converted to residential. You obviously have, 111 Wall that came offline, and a handful of others, 80 Pine, 25 Water. But, I guess some of these other buildings, they definitely have more availability. The B plus buildings in Lower Manhattan, right. East of Broadway. So do you think there's so much activity, it just starts permeating and starts infilling some of those buildings?
Yeah, I candidly, I think yes, to an extent, but it's not, trying to think about the right way to frame or to phrase this, but the location just doesn't work for some people, I feel like. And you probably know this better than me just from having more of the direct client conversations about strategy, location strategy. I think the tightness of the surrounding market will push demand to those types of buildings to some extent. I still think for as much conversion, as much office to residential conversion activity that has already been, it has either occurred or has been committed to, there's still probably potential for some more buildings, some more of the buildings that are closer to obsolescence, to go down that route, but maybe not at the pace that we had previously seen it. But I guess my point is I don't think we're going to see a rush to the east side of Lower Manhattan where suddenly we see this sharp, rapid improvement in the operating fundamentals. I think there will be more recovery than we've seen to this point, but it will probably be measured still.
Yes, I tend to agree. I got a kind of a one-off question. When will we see a major commitment for Terminal Warehouse on the west side? And I don't know if you've had the opportunity to see the product. It is probably the coolest product in New York. I mean, for any type of creative or tech company, exactly, It is incredible.
It's very cool. It's incredible. I don't know why, we haven't seen anything yet. I think we all hear rumblings of, touring activity and users showing interest, but there just hasn't been anything that's landed quite yet. So I don't know, maybe that's worthy of a bold prediction for this year, that we see the first big commitment. But I think it will take the right type of tech creative user who wants that, redeveloped, like brick and wood type aesthetic, as opposed to the glass and steel, the very big, wide open, creative oriented floor plates. The problem is there's a lot of competition in that geography in terms of that type of product. I think obviously Terminal Warehouse is the newest, the most recently redeveloped, and perhaps the nicest. But if you look at some of its neighbors, like the Starrett Lehigh building or Morgan North, neither of which are too far away, they kind of offer the same thing. So that is one of the, I would say, relatively few remaining pockets of Manhattan that is still a high availability microclimate and is very tenant favorable, all things considered.
I think some tenant, my prediction is this year, some large tenant is going to get a heck of a deal leasing either Morgan North or Terminal Warehouse, or maybe we'll see multiple tenants. But I just think companies will grow out of their existing buildings and there's going to be nowhere else to go, but they're still going to require a super creative, dynamic, newly renovated environment with outdoor terraces and all the other attributes of these buildings. And one or both of those buildings are going to land an anchor tenant. That's my prediction at some point over the remaining 9 months.
I think it's a good prediction, and honestly, whoever that is, like I said, it's got to work for you, but could be a great deal, especially in comparison to everything else that we're seeing out there in some of the more competitive locations and geographies.
Yes. Well, Matt, what else do you want to maybe summarize or conclude for the audience on either to summarize this quarter or what to look forward to going into next quarter?
Yeah, I mean, I think one thing that I failed to mention so far that I think is important to highlight, Lower Manhattan. I know we've already talked a decent amount about Lower Manhattan. It was a slow leasing quarter this quarter relative to the past couple, where we've seen some big deals from the likes of Moody's and Jane Street and others.
Amex, right?
But of course, Amex, right? We didn't classify that as a lease in terms of our statistics, so that's not part of the 12.4 million square foot figure that I quoted. But still, it's a nearly 2 million square foot commitment to occupy and develop to World Trade, which is obviously huge for, psychologically, for, the health of the city, for, outlook, and, it's inspiring in many ways, right? So I think that's certainly worth mentioning, just as a call out of, something representing confidence in Lower Manhattan, even if it isn't technically a lease.
Definitely. It is a monster commitment.
Yeah.
Monster. And it's net growth.
Absolutely.
For Amex.
Absolutely.
So that's huge.
And then, as far as other topics, it's a lot of continuation of trends. I felt like this quarter, the trophy and A+ market continues to tighten. We talked about it a bit through the lens of large blocks of available space and the limitations there. But I think, if we're looking for other things to look for or to predict, maybe not necessarily for next quarter, but for the balance of the year, I think we'll probably get another major anchor tenant type commitment to a new construction project before the end of the year. We saw Star commit to 343 Madison, which we included in our report for Q1. I think it was announced by BXP the first week of January. I think it may have closed right at the end of the year. But I wouldn't be surprised to see, another commitment like that for one of the planned Hudson Yards developments, or 175 Park, or even maybe 15 Penn. There's a lot on the table right now, so that would not surprise me to see something officially land this year, something else big.
I don't disagree. I think we will see it before year end. Well, I want to wrap things up, and first and most importantly, always thank you, because you always have tremendous insight, and appreciate you taking time out to go over Savills findings and overall market conditions.
I love it. Thanks for having me back. It's great to talk through it.
We appreciate it. Everyone, we're going to see you in early July at the close of Q2. But stay tuned for more episodes coming. We have some really exciting guests coming up over the following couple months. As always, Matt, thank you again, and we will see you all next time. Thank you.